half of this year, presented investors with a lot of, different options when it comes to investments. We saw a lot of even, things happening in the economic landscape generally, from inflation trends to interest rates to currency movements and all of that, and the development even in the financial markets. All of those things could continue to influence how individuals and businesses think about money. Now we are in the third quarter of the year, and of course the second half of the year as well. And one question remains on the minds of many Ghanaians: that where should we put our money, and what investment options offer the best opportunities, while managing risk? Should investors continue to focus on traditional options, like treasury bills and all of that, or they should be they should be turning their attention somewhere else? And this morning, we want to take a closer look at that. We're looking at the quarter three investment outlook, and also explore the opportunities, the risks, and all of that is involved. My guests are already seated. I have in studio Musa Hidir. Is that a name? Yeah. He is an investment analyst, and also Odum Ebenezer Yao. He is a financial analyst. These are the two individuals I'm having this conversation with this morning. Gentlemen, welcome.
Yeah.
Thank you so much.
Good to be here.
Yeah, good to have the two of you too. All right, fantastic. So let's get into our conversation this morning. We're talking about investment generally, but let's start from here. 2026. First of all, how has the investment climate or landscape really been this year? And I'll start with you, Eben. Then Musa, you come in. Yeah.
Yeah, so it's been an interesting trajectory across board. The stock market mainly, we've seen an impressive run in a couple of the companies that are listed. We are also privileged to see some IPOs. One, Zen Petroleum. We have seen Casaprec also come to the market, some indigenous companies that we have here in the country. So the stock market has been quite robust, over 60% so far in terms of the market return for the stock market. And then the fixed income as well has been good. If you look at the yields level across the treasury bill and across the other fixed income investments, you still see that they are still well above inflation, and they are rewarding investors with positive real return. So, that suggests clearly that even though you may have seen it in numerical terms, yields compress in that category, yet in terms of how it adds to consumers' purchasing power, as in from the returns, clearly it is well above inflation, and even the 91-day bill is still well above inflation, and that is positive. For mutual funds and other collective investment schemes as well, we have seen some good performance, and especially the balanced ones, they have benefited from the massive growth we have seen in the stock market, and then of course the fixed income market. So it's been an interesting journey so far. Last year was remarkable, but this year is also on another trajectory that investors broadly are excited about.
Fantastic. Right. Let me hear from Musa as well. On the same lines, what do you have to add to that?
Yeah, so at the beginning of this year, when we cast our mind from last year, clearly when you look at the investment landscape, from the macro perspective, how inflation and also the yield are behaving and all that, all of us, even unanimously, all analysts predicted that this year will be promising, and clearly it has come into pass. In terms of when you look at the volumes and all that has been trading, particularly on the stock market. When you just oppose that to the previous year, you can see that in terms of interest and all that, the level of retail investors who have also captured into the market has been something remarkable and has been trending in the right direction. At some point, the market even equaled last year's performance.
Right.
Yeah, I think in the first 3 months, and eventually then the market started dipping, which is expected because people will start taking in some profit and all that. And yeah, so basically overall, I think the market has been trending in the right direction, and we expect that particular momentum to take us through the half of the second year. Yeah.
So would you guys describe this period as a period of opportunity or caution or both?
Okay. Yeah, so I mean, historically, if you compare what is happening now to what we have seen in the past, clearly this is an optimal window for investors to maximize returns. I mean, over 100 billion in capital gains for the local stock market. This is a market
you're very much excited about the stock market.
I mean, it's a big cake, right? Over 100 billion. That's a lot. And over 8 billion in dividends, right? So that is for the stock market alone. Right. If you look at the fixed income market, some good numbers, interest paid so far over 10 billion Ghana cedis. So, I mean, it's quite interesting. And if you compare it to what we have seen in the past, and if you cast your mind back, for instance, in the last 5 years, you could see that 2020, 21, 22, 23 coming was some time that investors were struggling to have positive real return.
Right.
And now they are having it in double digits. So 2026 is impressive. I mean, we thought it was going to be a bit moderate as compared to the run we saw in 25, but it has reached expectations and even exceeded in some aspects.
I see. You want to add something to it?
Yeah, just to add to that, you know, they say if you want to look into a country's economy and see whether they are moving in the right direction, first off, look at their capital market and how things are going. It clearly mirrors the macro perspective of the environment. So like he said, when we cast our mind in about 3-4 years ago, where the macro environment was really turbulent and all that, having inflation around 50% and all that, the CD depreciating over 30%, at some points recognized as one of the worst performing currency according to Bloomberg and all that. During that time, when you look at the capital market, it was really at the bearish moment, but still the year-to-date return was averagely around 30%. So considering that and that trend that we had, particularly from the change in government and the policy shift that they brought in terms of macro stability, in terms of also cutting down their expenditure by way of the let me say the fiscal aspect and also the monetary aspect, also being disciplined. You can see some coordination within them, and all of that has brought into this level of momentum that we have seen. Seeing inflation trending downwards from 24 levels to now 5.3, and in terms of the yield, particularly the money market instruments, they have cut over 1,500 base points from last year to this year, meaning government is still maintaining that they are discipline, caution and all that. Right. So because of that, and because money has been, over the years, particularly during that time, the money market has been the one that people, those with the monies tends to put their money in because it has been promising and all that, and the yields have been up there over than giving it to the real sector and all that. Because of that, and now there have been that drastic shift. Now the yields, when you look at it, they are not really up there. So you can, because of that, you can see that money has shifted into the capital market, and because of that, we are seeing this particular upstream in terms of volume, value, and capital gains and all that. And also, when you look at the company's earnings as well, they are also adding into that particular trajectory.
Fantastic. All right. Now, talking about inflation, now we were seeing inflation drop. We've seen inflation drop significantly. Now we are seeing it go up again. How should investors interpret that? Really?
Okay.
Musa.
With this, I think largely when you look at it is from the international market, particularly what is happening in the Middle East and all that, the tension there because of crude oil, Brent trading at its all-time highs. At some point, because of the tension happening there, at some point the Strait of Hormuz has been closed and all that. Some had it as a windfall in terms of those oilless countries like Nigeria and Angola. They kind of benefited, and also those who are in the top petroleum. In terms of those who engage in the production, you get a point. But in the case of Ghana, because of still our economy, although we are trending in the right direction, we are still still in the leap, in the sense that any external shock, we tend to feel the effect, and because of that, we saw that in the export prices increasing and all that. But now I see it as a blip. Already they have already had a consensus, like more or less, like in a way to ceasefire.
Right, but unfortunately, I think that things are beginning to get up again, because I've seen some fires this morning. I was checking the news, and I know that the US fired, and then Iran has also retaliated and all of that. So we might go back again, know. But if you listen to the government statistician, even the June uptick that we saw is internal. It's not from external. Yes, if you look at the inflation that we saw.
Yeah, when you look at the uptick in terms of the figure, it was driven by non-food.
Yeah,
and when you look at non-food, is petrol. Petrol has been one of the big figures there, right. Having the heaviest basket. So I did, and if it is petrol, because we are more or less like dependent in terms of imports, crude and all that. So that's inflation from offshore trickles down into our economy, right. And all that. So it's all part of it. That's why we have seen that. But with the ceasefire and all that, I expect us to resume like the disinflation trend to kickstart somewhere.
Yes, I mean
August thereabout.
Yeah. So I mean, if you look at the trajectory, and despite all that is happening, you could see from the posture of the decision makers that there is a clear intention to keep inflation within a reasonable band, such that it doesn't distort the rate and the business environment. So we've seen a bit of the external shocks, but of course, and then we have seen a slight uptick in the numbers. But looking at the posture of the decision makers, it is clear that they want to maintain it within the MPC's target band, and that is helpful. Now, the good thing with respect to investment is that, you still have the rates reasonably above the inflation, which is purchasing power. So at the end of the day, your average treasury yield will still help you keep up with price pressures, right? So, for instance, the 364-day treasury bill, over 12%, and it presents more than 7% real return, and that is good for investment. So, yes, inflation will be there, but I think that the decision makers are well aware of, if you get to the double digit and the high teens, how it will look like for even the fiscal numbers and also the general business environment. So it will be well kept. And on the petroleum side, the subsidy has been helpful. They introduced the 1 cedi, to keep the prices in check, and then they removed it when the tension slowed. And so as we see it re-emerge, most likely they may reintroduce it and keep prices in check for the local consumer, so which is helpful. So the posture of decision makers are very good, and it's helpful for the trajectory we are seeing.
Right. I just want to understand this. So which investment options actually react to when inflation rises?
Yeah, so it depend on the type of investment and the exposures, right? If you come to the stock market bucket, for instance, it's companies that have their operation lines or their business models slightly exposed to price pressures. And for instance, companies that import their raw materials, when you have external inflation or inflation driven by external pressures, you could see that their input cost will rise, and that will eat up their top line, as in their revenue, and they may end up reporting lower margins. So which is not, and once the lower margins come in, investors will react to the financial performance, and you could see the prices shake. Now, for the fixed income bucket, that is very sensitive, in the sense that every now and then investors want rates, at least some reasonable basis points above the inflation level. They want at least some real return, positive real return. And so when it is going high, when inflation is rising, what it is that likely the investors will now want to demand higher rate from the government, and that will not be good for the government's balance sheet, right? Okay. But investors will want to see that. And the good thing is that the other side is that when inflation is rising, investors may want to demand higher rates, but the real return may still narrow, right? Which is not helpful on that side. But then, trust me, with all that is happening, I believe that rates, returns or yields across investment buckets will still be positive on the real level, and then investors will still continue to have some good returns.
I see. Do you have anything to add to that, or we can move on?
Not entirely. I think he has really touched on all the key
right
things,
right. Okay, now many Ghanaians actually hear, economic terms, can talk about inflation, you can talk about interest rates and exchange rates and all of that, but do not understand exactly how it affects their investments. I don't know if you guys can just throw some lights on that, so that anybody listening to us can be able to make sense of exactly what we're talking about. Buza?
Yeah, so inflation, basically, as the economic people say it, measures your purchasing power and whatnot. So let me take it in a layman. In a sense, when you maybe have like 10,000 cedis and you decide to keep it under your pillow and all that, you sort of invest in it for a period, maybe a year or two, that money that you had, maybe you could buy about, let me say, 10 bags of cement. So after maybe a year or two, that same 10,000 cedis that you have, if you go in to go and purchase the same quantity of cement, will be like you need more than that, or you get a lesser quantity of it. So that differential is the element of inflation coming in. So that's why it's best, instead of you keeping your money idle, it's better you put it somewhere, because you see the money as a paper money, still having the same let me say, worth in terms of the fiscal aspect of it. But when you go in to buy something, you realize that the value that you tend to get has diminished.
And it makes investment non-negotiable, right? Because inflation will forever be there. Even now that we are saying inflation is coming down, often I see people try to translate it as prices coming down. But if inflation is down, what it basically means is that the rate at which prices are increasing have slowed. But it doesn't mean that abstractly prices have stopped increasing. So prices will forever increase, because different components or different drivers affect prices, and we will still have price increases around us, and it makes investment non-negotiable. So it means that at every point in time, whatever cash you have or whatever money you have and you do not have use for it in the next, I say 1 week or in the next 1 month, right, you should seek for an interest at least equal or higher than the current inflation level, because inflation is measuring how prices are increasing around you. So if inflation is 5.3% and you leave your cash idle and produce nothing more than 5.3%, what it means is that what you can do with your money for a certain period, now you need at least 5.3% more of what you had to be able to do the same thing that you could do a month or a year ago. So that is the practicality of it. So it means that you should always seek a return on every idle cash, every cash you do not have use of it in the next 1 week, because you can have investment generation returns for you in 1 week. And trust me, even corporates, now there are 14-day papers in the fixed income market, like repurchase agreements, and 14 days, that's 2 weeks, and you can make some returns on it. So it is non-negotiable that you consider investment.
Right. Okay. Now let's get into the conversation proper. And I want us to begin talking about, the most popular option of investment for most Ghanaians, and we're looking at fixed income. So we're looking at treasury bills and all of these things. What is the outlook for treasury bills in quarter 3 of this year? I don't know if Musa.
Yeah, so with treasury bill, that's the money market. I think we expect it to government to remain disciplined in the sense that they would really maintain that level of discipline that they have, in the sense they wouldn't want to spike up their appetite in terms of the monies that comes in from the PDs and the investors at large. And that will also gauge on the inflation trajectory, because when inflation starts to move up, you expect people would start to demand more because they want to keep their returns still positive. So broadly, as it stands now, and based on the what is happening in the macro perspective, we expect the rate should be within the BOD band. Yeah.
But are they still attractive compared to other options?
Yeah, they are still attractive in the sense they are still above inflation. So you still have that return there. So when you look at the investment basket, fixed income tends to be the lower because of the lower return. Although you are being guaranteed return mostly above inflation, but the return is just low, followed by, I think, the mutual fund. That's the collective investment scheme before the stock. And now because of crypto, crypto tends to be the higher. So on that line, fixed income promise you a return, but just that is a little bit lower compared to the other investments. So based on your investment appetite, and also maybe your age, in a sense that you have galloped that volumes of money, you wouldn't want to take any too much risks, in the sense you can, in the stock market, although it is promising, there is also the downside where you can put your money, and within some few trading sessions, you can lose almost half or everything. So maybe because of that, after you have galloped, you would want to keep it in the safe place. Right. At least you should beat inflation. Yeah, so that one fixed income would do, or maybe the mutual fund. Yeah.
Okay.
Yes,
you want to add something to it?
Yes. Across the treasury, still look good, right, for investment, because look, think of it. Now, investors are enjoying between 0.5% to about 7% in real returns, as in return above inflation, right? So that is still good for portfolios, good for individuals. Now, it depends on where you are, right, and your risk appetite level. For some people, there are starters, and for starters, you would not want to zoom into the high risk, high return areas. You'd want to start with where your return, your capital is guaranteed, right, from the day of your investment. So it has always been good, and it is still good. I mean, if you cast your mind back 3-4 years ago, when the treasuries were doing like above 30% and inflations were in the 50s, that was like negative 15 to 20% return, right? Negative real return. Now you have it, inflation at 5.3, and you have the 364 day at 12.8+%. So
that's more than
about
twice.
More
than double.
Exactly, which is interesting. I mean, with this, I mean, you are better off than one keeping his or her money in the susu box or in a regular current account, or doing something else with their money and fetching that. And so the treasury bill have been good, but the rate, if inflation continue to persist, we may see it take up slightly. And also what we have seen is that the excess liquidity that the treasury benefited from the first half of the year is drying up gradually. So,
but what do you mean by that?
So at the beginning of the year, there were so much funds that were looking for investment options to rest in. I mean, they were not finding opportunities to invest. But now it has been absorbed across board. The stock market has absorbed some. At least we know Casa Precon has come to absorb some 700 million cedis. You know, Zen as well. So now that liquidity, that excess funds that were available in the system has been absorbed, and we see that when the government comes to the market to borrow through these instruments, for some weeks we see under subscription, you know, broadly not because the rates are not attractive or something, but also because the liquidity are drying up, and that luxury to keep the rate within a broadly stable range, you know, is getting off. So clearly, we see that the rate may still continue to take up slightly higher, and the opportunity is there for investors to at least receive some returns above the current inflation levels. So yeah, it's interesting, and the outlook is positive for investors.
I see. So if anybody has some good money sitting down, I mean, they can put it in treasury bills.
Yes, not bad at all.
How about the other fixed the fixed deposits, bonds, and all of that? What do you have to say about that as well?
So I mean, fixed deposits often we've seen that the rates have hovered around the treasury bill rate. So it's just similar to the bill. I mean, the return, I mean, in terms of the return dynamics, have been similar to the bills. So it's similar to doing the bills and all of that. Now, if you look at the other fixed income basket, it could be, i.e., fixed income funds. What it is that historically, majority of these fixed income funds have, especially the money market ones, have allocated or concentrated the investment in government securities. And then now we've seen the emergence of repurchase agreements. So we see that now most of the funds are also considering repurchase agreements, and it is helping the portfolios. But now the yields on fixed income funds are mimicking the treasuries, especially the 364-day. So they are all on a similar trajectory. So yeah, I believe that all in, you are not worse off. Either you are doing fixed income mutual fund or the direct treasury bill, 91, 364, 182-day bill. You still have some good returns, you know, for your portfolio.
Right. At some point in this year, we saw that treasury bill, the interest rates were quite down. Now they are beginning to come up a bit. Do you foresee it increasing, or you foresee it coming down? What's the outlook for that?
Yeah, so currently the drivers for a potential uptick is hinged on one, the fact that the liquidity is drying up, and government may struggle to meet their targets. During some auction point. So when the government is not receiving enough bids, what it means that it might be forced to accept bids at rates slightly higher than the previous levels. So that could be one driver. The other thing is that investors have, especially institutional investors, most of them have signed their hurdle rates, I mean, as in their projected rate for the year. And they have expectations of a certain range of real return above, I mean, as in return above inflation for the year.
Okay.
And so, for instance, currently you see the 364-day at 7%. Now, if they, for instance, expect to be in the, they are projecting to have it in that range, what it means is that immediately inflation ticks up by, let's say, 100 basis points, they are going to revise their bid to, you know, reflect this, to make sure that they still have the around 7% real return on the 364-day bill. So that is one of it. If inflation is well kept within the band, the rates may also be well kept within the single digit and then early double digit for the 364-day band.
Okay. But what happens to investors when the rates begin to drop, I mean, even further?
So let me start off with this. So, I mean, when it is dropping, what it means is that your real return, as in compared to how prices are increasing, I mean, and your returns, it is narrowing. Okay. And when it is narrowing, it means that your purchasing power is clearly reducing. That's for the individual investors. And also for institutional investors, especially the fund managers, you could see that in terms of their returns to investors is going to be narrowed, or it may fall short of what they are projecting to have.
Right.
And might be a bit inconvenient. But the good thing is that about in all of this, the projection is to is that it's still going to be kept well above inflation as it returns, and also yields on the treasury is still going to be kept well above inflation. And for what we have seen in the first 6 months, of course, the next 6 months is not expected to be as impressive or to run as fast as we saw in the first 6 months. But then it is still going to be kept, or the year is going to end in the green.
So treasury bill is an option. But what are there some risks that investors should look out for? I mean, before putting their money in there.
Treasury bill?
Yes, treasury bills.
Treasury bill, like the books has been telling us, when you put your money in treasury bill, what you get at the end of the period.
You are assured.
You are assured of it. So in terms of default or any risks at all, it's really minimal, unless the government defaults or what happened the last 3 years happens.
Which is most unlikely around this time.
Exactly, which is most unlikely. So the risk there is very minimal. That's why the return as well is also that level. So looking at it, you just get your return slightly above inflation. But in terms of risks, I think is very minimal, very, very minimal. Yeah.
Okay, you want to add something?
Yes, I mean, historically, especially the treasury bill in particular, the government hasn't defaulted on that, and that is a good record to rely on. Now, what happened 3 years ago? At times we look at it from the investors' perspective, how they were affected and all of that. But the government also had its own share of, the ripple effects. Now it's not though investors will just give you money like that. They are very careful. They exercise caution before allocating funds to government investment products. And so that clearly suggests that the government is going to make sure that it is positioning itself, to ensure that investors are also well protected. So in the near term, we don't see any significant risk around the treasuries.
Okay.
Clearly, the government is going to try hard. In fact, the sentiment, the positive sentiment that were building up until the last 3 years, that the government lost drastically a significant portion of it, they are now trying to rebuild it. We are not fully out of it, right? People are still exercising caution. People are still thinking twice. Investors are still viewing Ghana's risk as not all green. I mean, so there are still some cautions around it. So, and the government knows the importance of keeping its credit worthiness, intact. And so I believe that with the poster we are seeing, they are going to continue to, offer investors that little to no risk, with respect to the products that they put out.
Okay.
And that is it for me.
All right. Exactly 36 minutes after 9. This is a business breakfast on Z101.9 FM with me, Nitra Bihamon. If you just tune in, this morning we're talking about investment outlook for Q3 of this year. And my guest, Ebenezer Odum, he is financial analyst, and also Musa Hidir is an investment analyst. And these are the two individuals who have joined me in studio this morning. We're looking at exactly where you can put your money this morning. We've spoken about treasury bills already, and the outlook is quite positive, and so you may want to consider that. But we're going to talk about stocks very soon, but you're also free to join the conversation. Send us a WhatsApp on 0544-321019, 0544-321019. I'm happy to read your messages for you. If you have questions, feel free to send them to me as well. You can drop a comment under our live stream. We are on Facebook and we're streaming live at ZFMGH, and on YouTube we're at Z Multimedia. Feel free to drop a comment under the live stream. I'm happy to read them for you as well. If you want to call us, feel free, call us on 0544-321019, 0544-321019, and we'll give you the opportunity to share your thoughts with us this morning. All right, gentlemen, so I think enough of treasury bills. Let's move to stocks.
Yes.
And I see even gets excited when we want to talk about stocks. What is the outlook for Q3? For stocks. Musa?
I think the outlook looks strong. We just finished Q2, and I think in a week or two we are already in the earnings season. In a sense, we expect Q2 result to come. Per analyst projection and what they have seen, we expect a strong earnings performance from the listed stocks or the companies listed on the exchange, from the bank and all that. Just that the only thing here is that when you look at what they are being used to, particularly in the banks, because of at some point in time, they were being, because of governments giving promising them yields that are quite high and all that, and they can really get it on the really comparing that to investing in the real sector. So they were making a lot of money on that side of things. But now, because of the yields coming down, we expect maybe in terms of investment income, that particular level of return should come down in that sense. In that sense. So broadly, but we still expect them to post a good performance. Aside the banks, maybe the telco, MTN, who has already shown a strong momentum in their last quarter result that they posted. Q2, we expect that particular level but that particular momentum to take them into the next quarter, and that will really influence their price performance in that sense when the result that they post will be within investors' expectation. Surely you see that reflecting in the stock price. And same with the FOMCGs, that's the fast consuming movable goods. Also, we also expect that particular thing to happen in that sense. So broadly on the stock market, I think although we have seen a lot of correction in the second quarter, which is expected because of that huge rally that we saw, people have taken profits and all that. But with the earning result that will come, that would really revise the trend that we've seen to the second half of the year.
Right. Okay. Vivian.
Yes, I mean, I think this second half for Q3 and Q4 is pregnant with many opportunities. I mean, across the listed companies, I still see a number of firms that the market has yet to fully price in its fundamentals, right? And especially in the telco bucket, also in the financial services bucket, you see that a number of the stocks have not reached their full potential, as in terms of the price, reflecting the fundamentals. So despite the impressive run that we have seen in the first 6 months, that's still a good number, right? I mean, a good number of stocks, I must say, that have yet to move to the levels that we projected them to be. And what it is that
you're not allowed to mention specifics. Right?
yes. I mean, yes. I mean, what it is that we also have seen a number of corporate actions that the market is expected to react and then adjust to reflect them in this very quarter, right? And so, and that makes it, impressive. I mean, that even though my projection is that the second half fully, the next 6 months, will not be as impressive as it has been in the first half of the year, but it will still generate some positive returns for investors across buckets. Now, what it is that there are one or two companies that are going to be declaring one interim dividend in this quarter. Some are also going to declare final dividend in this quarter. There are some companies that their accounting year cycle ends in June. And so it means that for June, looking at the performance, they are going to declare some dividends. And so some of these things, together with first half performance, is going to trigger portfolio restructuring across. And that is going to drive some of the stocks up. For a selected counters too, we are going to see some reset and then readjustment in the price. But all in, I think that the second quarter also has opportunities in some stocks. And then those who position their portfolios well are going to benefit from it.
What do you mean by positioning their portfolios well? So which sectors specifically should people be paying attention to?
Yeah, so I mean, the financial services have been a major driver of the overall market. Broadly, if you see the market doing so well, if you go and look at the market, you see that the financial services are dominating. And the telco has also been an anchor and has been a major diversifier for portfolios.
But telco, how many? Is it,
yeah,
is it
just one. Yes, but I mean, it forms like 30% of the overall market size.
Right.
So, it anchors a lot of things.
Right.
Yeah. So the financial services market is expected to continue to anchor things to, design things for us in this quarter. Also, if you look at the OMC, which has now broadened by a new issuance. Now we have, I think, 3 companies in the category. It is expected to also drive things. For some OMCs, we are yet to cross their ex-dividend date, so their dividends are still active, and investors have the opportunity of being part of that declaration. And so the financial services, the telco, which is the sole ranger, the OMCs are expected to anchor things. The FMCGs, I see a moderate play in here in this half of the year.
All right. So that's also a good place to look at stocks. And from what you've mentioned, it appears that across all the sectors, right?
Yes,
all the
yes,
categories.
yes.
Yeah, we're going to see some good things happening there. So if you have some good money, that's also somewhere you can actually look at. Okay,
Exactly.
then it looks like this year is, the Q3, or this third quarter is also going to be very positive, isn't it?
Yes.
But I don't really expect it to be what we saw at the beginning of the year.
Okay.
Maybe a little bit of momentum will turn down.
Right.
Yeah, but I think here it will be based on their fundamentals, the reporting, the results.
Okay.
If it is stronger than expected, surely investors will price in that particular upside on the stock price, and that will push the stock up. Other than that, I don't really see a lot of upside.
Right.
You get the point. Yeah. And also to add to the stocks, the insurance sector as well. They also behave like the financial stocks also. So we also expect them also to follow that particular trajectory. So all in all, I think the stock market has been promising and is still promising. So although maybe you haven't taken position, you are still not late. It's still you are still in the best position to take position.
All right, fantastic. Now let's look at mutual. For those who lack investment knowledge a bit, are mutual funds and collective investments a good entry points at this time?
Yeah, I think they are particularly if you are a newbie, a new investor and all that. You can kickstart your investment journey from that particular trajectory. And you like you said, the mutual fund is just a basket containing different investment products, mostly on the stock market. And we have mutual fund that track some stock market, some companies on the stock market.
Yeah.
We have mutual fund on the money market as well. So it's one of the ways that you can kickstart your investment journey. At the end of the day, you are guaranteed that your return is above that of the money market, and also you get some dividends and as well. So broadly, if you're a new investor, it should be one of the things that you can start from there. Then maybe you can graduate into the stock market where you can take a lot of bit of bets in a sense, going hard on a company or not. Yeah. So I think the mutual fund is a good way to kickstart your investment.
Yes. You want to add something?
It's very good for especially starters in the sense that now most mutual funds offer you the flexibility to have access to your funds when you want to, in a day or 3 days. So for most people that are starting investment, what it is that often they think, they can go, they can hold up for a long time, right? So some think, they can do 3 months, 6 months without touching the funds. But oftentimes that's a deception to themselves. So they end up, they invest, for instance, in bills, and then midway they want to withdraw, and mark-to-market conditions may cause them to have some slight losses on the capital. So mutual funds has been one of the options that has helped starters to organize up. So you have to organize up at the mutual funds, and then you ramp up to exposing yourself to directly the treasuries and then the stocks, right? So the mutual fund, I think, is a starting point. I mean, organize yourself there. Try injecting something for 3 months to see whether you will not touch the money. That's how I test people. Have you invested in, for instance, a mutual fund and not touch it for like 3 months? Then it tells you, okay, maybe you can try a 90-day treasury bill. So the returns are not bad, most of them. And I must say that the equity ones, the ones that invest in stocks and the ones that are balanced and partially invest in stocks and in fixed income have done so well. Some are doing 30%, 40% already, right, from January to date. And that is impressive. The ones that are money market focused only have also done, some are already above 10%, some are, although in the single digit, but compared to inflation, that is still positive real return. And that is a good one there, right? So for starters, mutual fund is one of the ideal options for you to consider. And also it helps you also manage emergency funds. I mean, what I see people do with their emergency fund is they keep it in cash, more cash. But mutual fund is a near cash product. And if you do mutual fund, for most of them, you can still have access to your cash, but it can still give you some returns, right? So instead of keeping, for instance, your emergency fund in cash, raw cash, you can keep it in mutual fund, which is a near cash. You can have access to the funds when you want to, at least maybe some amount of it, you can have it when you want to, and it also offers you some returns, right, to compensate you for allocating to that. So yeah, mutual fund is also a good option for investors to consider.
But you see, I mean, we all know what happened with investments in this country a few years ago. Yes, and so a lot of people are hesitant, trying to how can somebody protect themselves from any of those issues that happened in the past around this time?
I think first you should know what you want to do, like where you want to put your money into. You should know what that thing is. You need to be a little bit informed on it. If it is the treasury bills, you shouldn't go with the idea that because you are investing, you're expecting some 30 returns year to date and all that. The treasury bill hardly guarantee you that thing. So you should be informed, and by so doing, you can get informed through listening with a broker or any financial analyst, or maybe listening to program or discussion of this sort that will keep you updated on what is trending and all that. So I think that's the first step: getting yourself informed, getting yourself updated on the various investment schemes, and also knowing your risk appetite and the purpose why you are investing. So if you know you are investing for a long term, then maybe the stock market will be good for you, because the stock market kind of pricing future returns today. So you can consider that. And before that, even with the stock market, you have to look into them, because there are so many stocks there. You should look into them and maybe consider look into the company really that is promising, and maybe utility based. Their usage is something that you can trace it. You can trace it in the sense that you use it. You are part of their consumers. So why don't I become a part owner of it? So these are some of the things that you need to look into when you would want to.
Yes. So I mean, just as Musa said, risk is a lot for you when you don't know what you are doing, right? And then also what happened nearly 3-4 years ago, where mark to market has to be introduced, and then most investments have to be revalued, and then we saw the values coming down. Now the mark to market is being used each day. That is the norm now. And so each day your investment reflects current market prices. And so what it is that when there are even emerging risks, you see it day after day, right? Because your investment will continue to reflect it as the day goes by and all of that. Now, for what you should do to prevent yourself if any of that sort should happen, is you should always diversify, and commonly, as we say, you shouldn't put all your eggs in one basket, right? Something small in mutual funds, something in stocks, something in fixed income products such as the treasury bill, the bonds. So spread your investment across, right? So that if the stock market is slowing, you have the fixed income market intact, the other investment options intact. And what we have seen is that sometimes when the treasuries or the fixed income products such as the treasury bills, the bonds, when we see the yields on them moderating or coming down, we see the stock market shooting. Because attention is now moved to the stock market. So if you are now diversified, what it is that when this basket is going down, you have this bucket going up to offset the losses or the reduced gains that you are seeing in the other basket. So you should always spread your investment across. And even if it is 1,000 Ghana cedi, right, you can have 500 cedis in stock and 500 cedis in mutual funds. And depending on your investment interest and your investment goals as well.
All right. Gentlemen, we have to wrap up now. Our time is up, sorry. And so we have to go. So, but beyond the traditional investment options, are there some other things that people should, some other investment opportunities that people can take advantage of around this time? Or we should just focus on the traditional?
Yeah, so let me say that the current environment also presents a good opportunity to do business, right? You have prices broadly stable, and the fiscal bodies are not introducing taxes as much. So what it means is that business environment is stable now, and you have access to funding at cheaper cost compared to what we have seen in the last 3-4 years. And so doing business now is very good. Now present an optimal window to do business, to start up something. So as you are considering the traditional, the stocks, the bonds, if you have some ideas, now present an opportunity for you to, set it up, and scale it up, right? Income levels, as prices are stable across board, and incomes are within reasonable range. And so trust me, that small idea, you can start it off. And I've always preached business because, business, it offers the opportunity to contribute to the state, to offer employment to others, to also expand your income. And business has been one of the best paying investments historically. And then as well, invest in yourself. You should be more valuable. You yourself, you should be best paying, should be on top of your game. So invest in yourself, invest in business, and I believe that that is a well-diversified portfolio to have in 2026 and beyond.
Right. Okay, gentlemen, thank you very much for coming. Let me just take your final thoughts as well. I think Eben has spoken, so maybe you can just, if there's anything you want to tell anybody at all, maybe somebody has some good money on their hands right now, they're confused. What should they take away from this conversation?
Okay, so what I would like to say is that is when you look at the whole landscape and all that, is I would say we are moving in the right direction, in the sense that you can see the youth taking position in this particular investment opportunity. Not like some years ago when we are talking about stock market and all that, they see it as something that is abstract. You can be here, you'll be investing in the US market, buying Tesla and all that. It's something that we are lucky to have now because of the technology, and also some of the brokers being sophisticated in the sense of having platforms and whatnot that you can be at your own comfort of your zone and invest. So I would advise people, the little that they have, they should consider putting it into this particular thing. Within the short period of time, they could start to see the return that they make from there, and from there maybe they could build up into something exponential. Yeah.
All right, gentlemen, thank you very much for your time this morning. Thanks so much for sharing your insights with us as well. I'm really grateful that you came.
Thank you.
All right. So that's how we wrap up today on the Business Breakfast on Z101.9 FM. Musa Hidir is an investment analyst, and also Ebenezer Odum is a financial analyst, and these are the two individuals who joined us. We've had a good conversation. We've spoken extensively about treasury bills and also about stocks, and they say that the best investment that you can also do beyond all of these traditional ones is to go into business or also invest in yourself, and that's a very good diversified portfolio. I like how he put it. And so thank you guys very much for coming, and thanks so much for also listening to us right here on the show. We're back again tomorrow for some more interesting conversations. Tomorrow is Thursday. We're doing something lifestyle. And so make sure that you tune in and let's have a good time right here on the Business Breakfast on Z101.9 FM. I'll see you tomorrow. My name is Nitra B. Hammond. Up next is The Brighter Side with Jeremy Okor.